So what happens if I don't pay them back? Or do I have to pay them back? We get those questions commonly. Well, firstly, do I have to pay a life insurance policy loan back? Because I hear the word loan, what comes to mind? Interest and payments. With a life insurance policy, do I have to repay them? Am I required to do so contractually, like I would be with a mortgage or any other loan? And the answer is no. It is optional. We're going to look at an example here shortly of exactly how a policy functions if I don't pay loan back. Policy loans, when I take them from a life insurance policy, the big attraction is because it is a loan, it is technically a tax-free transaction. This is assuming the policy is not a mech, it doesn't lapse down the road, details covered in other segments. But when it comes to repayments, no, I am not required to pay them back. It may be in my best interest, so you want to look at options. If I do pay it back, maybe I only pay the interest. See the different options up front, but again, the answer is no, I do not have to pay it back. So then the follow-up question to that is, okay, what happens if I don't repay it? Will it hurt me? Well, that's what we're going to look at here. So we've got a spreadsheet we're going to look at, which is going to show a policy with an individual paying money into an account. Anytime we model a loan, it is beneficial to first see, okay, here's what the account looks like when I simply pay money into the policy, and what does the growth look like? Because first and foremost, maximize the cash value of the account. Looking at it in the sense that if I maximize my monetary value first and foremost, what does that do when it comes time for loans? I've got more money to borrow against, more money to use for retirement down the road. So what we're always doing first and foremost is looking to maximize the cash value of the account. So the example on the left, we've got a 35-year-old male where he pays in $20,000 a year. Break-even point is between years 4 and 5, which is solid. And this example on the left is pretty straightforward. I'm just paying money in and letting it sit and grow. Okay, now let's compare that to the exact same policy where I'm going to take out a loan of $120,000 and I'm not going to pay any loan interest, no principal payments, nothing. Just as if I would take a withdrawal out of the account, here I'm going to take out a loan and that's it. I'm going to use the loan here to pay for student loans or some type of debt. So before we study the loan, what's good to look at, just to validate that everything's the same here. Here's my cash value on the example on the left, $126,313. On the right, identical values. So again, this is the exact same policy. One example, growth. He pays $20,000 for 20 years. And the next example, loans and no repayments. So I pull out that $20,000 loan in year 7 in this example. I can take loans out really whenever I want. The cash value, view that as your line of credit. That is the equity that I have access to if I'm going to compare this to maybe real estate and accessing equity in a property. So when I pull out $120,000, I see a reduction compared to the example on the left. Now, we don't have the dividends or interest columns on this spreadsheet, so if I pull out a loan and I do not pay it back, what happens? The interest accrues, adds to the balance, and it compounds over time. At the same time, though, the company is going to continue to pay me dividends and interest on any money in cash, and also that $120,000 that was pulled out. So even though I pulled it out, I'm still earning interest on it. Just as if I had a home, I pulled a mortgage out against it or a line of credit, and I wasn't required to pay that back. If the home still appreciates at 5%, what's going to happen? I still get that 5% appreciation. A line of credit or mortgage will not impact my appraisal value. All right, so if I go down to year 20 here, at the end of the funding period, what's he have in cash on the example on the left? $635,000 in cash value, meaning he's paid in a total over 20 years of $400K. He's got $635,000. Example on the right. So he's paid in $400,000. He's also pulled out $120,000, which would make his net out of pocket $280,000. So I've paid in $280,000. I've got almost $400,000. So I can look at it that way in the sense I still have a positive return. Yes, the loan hurt me if I compare it to the example where I would have just let the money sit and grow, but I still have a positive return on my overall contribution. And even though the loan balance is growing over time, in this example, it really doesn't matter because the interest earned is easily exceeding that. And the cash value and death benefits I have over here, it is important to note that these are the net death benefit values, the net cash values, meaning if I die at age 60 here, I see this loan balance of $288,000, the $1.4 million already factors in what the loan is. Here's the amount that is paid out to my beneficiaries tax-free after satisfying the loan. Important to note that. One last thing to touch on, if I decide to pull out a loan and pay it back or not, remember the company is going to do what? They're still going to pay me interest on any money in cash and funds borrowed. How they do that, what they are holding as collateral is my death benefit. So we took that loan out year 7. Look at year 7 on the growth example, $1,039,000 and $118. I pulled out $120 over here. If you do the math, how much did my death benefit decrease by? Exactly $120,000, dollar for dollar reduction. So, simple answer. Do I have to pay loans back? No. What happens if I don't? Well, I have less money as what I would have had otherwise, but I can still have a positive return. I want to look at any example. If I'm loaning out excessive amounts, things could be a bit different. But overall, I should be safe as long as my agent or advisor is properly educating me on the pros and cons and any potential dangers.